try and sort of put this into how does it work for each film. When the modelling was originally done, it was taken into account that there would be a studio involved, whether that's a Paramount type film or a Universal, or as in Daybreak it was Lionsgate. So we basically said, look, there's got to be different ways of how a film is going to get financed, and that even though a distributor may come on board like a Paramount or Universal, they may only take certain territories. So what we've tried to do is to do a little model to show for 3 different sorts of plans as to what the configuration might be and how it would come together. So in this first model, we've said that there's a studio, i.e. like a mini studio like a Lionsgate, and that they would come in for a third, which is, in this case we've used a budget of 10.5 million, and they'd come in for 3.5 million. The producer offset at a third would be 3.5 million, and the loan fund would come in at 3.5 million. So it's a third, a third, a third. And that the recoupment position on this would be, for the fund, would be pari passu with the distributor. So every dollar that comes in, once they've taken off their reduced commission and their marketing costs, the P&A and that, the money would be split 50-50 with the loan fund. And so therefore at 66% of the loan would be repaid, although there's still some interest to be paid on that. So this is a very straightforward model for the producer. It's basically a Lionsgate coming in. They would cash flow. You wouldn't necessarily have to borrow, but they would cash flow their part of it. The loan fund would obviously cash flow its part, and you would still be looking to borrow against the producer offset. So that's the straightforward model, which is if you have a distributor coming in and they're taking world rights for that, and will be distributing all over the world. The second model is a bit different, and it's what's happening a bit, and starting to happen with some Australian films even at the moment, where you're getting people like a Paramount or a Universal who are looking to supplement their distribution slate in certain markets in the world, and they're going to take certain rights. So again, for this example, we've used the film at 10.5 million, and what we're saying is, and this could be Universal, it could be Lionsgate, it could be Fox Searchlight. Paramount's only there as an example. And what we're saying is for them, on this kind of a film, because it has some high-profile actors in it and the kind of story that it is, that these are the amounts that they're going to put up against these territories. And for Australia and New Zealand, we said they're putting up 750, for the UK 750, for Germany $1 million, and France $1 million. So you're basically getting a third of the money from those 4 territories. Paramount may or may not have an option to take it for other territories, but you're most likely going to have a sales agent, because they're not going to take it for all the territories. So you have a sales agent that's going to sell all the territories that Paramount don't take, and they don't have to put up in advance, but they'll obviously take a commission. So in this instance, what would happen is that Paramount takes those territories, puts in a third of the money. The PDFF loan is now against the rest of the world. So what has to happen is that the loan manager needs to look at it, look at the sales estimates, and feel that the territories that are left gives them a good chance of recouping the 3.5 million, which is no different than gap funding. It's a very similar concept to gap funding, and they will assess that, probably not as stringently as a bank might, but basically that's what the fund has to look at. And again, you would be borrowing against the offset. It may also be, in this instance, that with Paramount, is that they're not necessarily going to cash flow. You may have to borrow that. So you're now doing a borrowing with the bank for both the producer offset and the advances against those territories from Paramount. Paramount, no doubt, will cross all those territories and keep all those territories, so whether you see any overages will depend how the film performs, but you do have the rest of the world to get the rest of the money from to repay the PDFF. And again, this is a simpler version because we've got a studio again taking certain territories, so it's just the one document you're getting for that. You're then getting the PDFF, and you're having to borrow against the offset. So pretty straightforward structurally what you have to do there. In the third plan, it's slightly more complicated in that you don't have a Paramount or Universal in there. It could be that you have, you know, whether it's ArcLight or Myriad or any of the many sales agents who are going to go and sell certain territories for you. And again, we've used some European, like Australia, New Zealand. You're getting 600,000 this film. You're getting $500,000 out of the UK, $500,000 out of Italy, and 1.85 billion out of North America. And again, because the kind of film it is, if it has some action in it, the North American deal may happen. It might just as easily be that North America isn't pre-sold and that you can put France and Germany in there for that same amount of money. But basically, this is a traditional model of going out and getting a sales agent to pre-sell certain territories of the film. Once again, the same thing would happen here for the PDFF, is that they would have to analyze what's left in the rest of the world and what is it's worth, and is it worth the $3.5 million or somewhere towards that. So similar scenario, and then you have the producer offset. The slight difference with this one is that there's no doubt with the previous example with Paramount involved, we all know that that helps. If a major has your film, even in just certain territories, it gives cachet for other territories to buy into that film. When you're doing pre-selling and you're just selling to individual territories, then I suppose some of that will depend on the quality of the sales agent and the strength of that sales agent, whether they can parlay these deals into other deals for the rest of the world. So that's really three scenarios to go with. As I say, originally when this was modeled, we were just looking at a studio coming in or a mini studio coming in or one of the specialty studios coming in and cash flowing. But the market has changed, and if we look at even the most recent film, like Stephen Elliott's film, for instance, you know, there was quite a few pre-sales in that. If you even look how King's Speech was put together, there was a lot of pre-sales in that. It wasn't one particular studio that came in. But if you look at, I mean, one could call Omnilad a studio in this instance, insofar as, you know, the amount of money that they put up for Tomorrow When the War Began. And then you have something like Sanctum, which had a deal with Universal for certain territories that was worth about $12 million. They had the producer offset that was probably worth around $12 million, and probably maybe a bit less. And then you had a bank getting the balance of it. So that's really how it works. It's very straightforward. There's nothing new in any of this, but that's a scenario that sits there. An argument can be put that, you know, well, these advances are high. Australian films don't normally get these kind of advances, and that's absolutely true. But we're not talking about the normal sort of films that have been made. We are talking about films that have a cachet because of A, the story, a more universal story, and probably has some marquee casting in it. This model will only work if you have a project that people want to pre-buy elsewhere, and that comes down to the commerciality of that project. So I'm going to hand back to David to you the finishing up and just make them. What are you doing? Yeah.
I just want to make a couple of points at this stage before we hand back to David for further elaboration on the model. Emil Sherman has gone on the public record as saying, had this scheme been in place at the time he was putting together the finance for King's Speech, in all likelihood, King's Speech would have been an Australian-UK co-production. In further discussion with Emil, he's reasonably confident that he could have made it as an Australian production using this model. So it's out there, and I know when we did the Sons of Tomorrow When the War Began with Chris Knapp, Chris saw the value of this for Tomorrow When the War Began. He might have changed his views on the way through, preferring an equity model now, but it is designed for that sort of film. And I think we've got the talent here to be able to deliver on this. Certainly, you know, with Emil and Omnilad and the Sanctum boys, I mean, there's plenty of talent around to drive this model. I just want to point out there's a fair amount of scepticism around about how much would the majors put into this thing. How would the major distributors, the Universal, Paramounts, Sonys, come on board with this? Well, we haven't got a cast iron commitment from them, but before we extended the the work that David and Barry did, we made a concerted effort to go around to the majors to brief them on what we were thinking about and prepared to put forward to see what their reaction was. It is as challenging for them as it is for the producers, but we got a reasonably good feedback from the majors. They could see the advantage of this, they could see the potential. The view that Tony takes is that most of them have got one or two at least good Australian films up their sleeve that they would go into production on if this model was in place. The third point I'd like to make, just briefly, it's a question of the evaluation on this, and we've referred to it on the way through. Yes, it would be managed and administered out of Screen Australia. The sort of evaluation we're seeing Screen Australia apply to this would not be creative evaluation. It would be due diligence on the commercial terms of the deal. In other words, satisfying themselves with the bona fides of the 30%. After that's been satisfied, tick the box, away you go. So can I just throw to David now to continue with
I've only got a few more remarks, and then so we can have a cup of tea in a minute, and we'll start back with questions. What I just wanted to do in summary was to summarise the proposal from the perspective of the major stakeholders, i.e. producer, distributor, government. From a producer perspective, I think the benefits of the idea are obviously a new financing avenue, a different way to finance. The second thing about the fund is that it's essentially enabling bigger films. And I think there has been this is about ambition, this fund. It's about enabling ambition. That's its purpose. And it takes us back, I suppose it harks back a little bit to the 70s and the sort of films that Tony talked about before. From a producer perspective, the fund also potentially enables a somewhat enhanced equity outcome for them. And what I mean by that is that we're talking about loan funds here and advances. Now obviously, it may end up in any particular deal that some equity, is traded. But essentially, in principle, there's a potential for the producer to substantially own the films. Because we're not talking about equity deals here, fundamentally. There may be equity deals done as part of securing the overall financing, but the starting position is the producer with 100% of the equity. So it's just trading back off that. That's what's enabled here. And then, as I said, when we modelled this, we had a 30% expected average offset recoupment. I do caution that averages are misleading. Some people will do really well out of it, depending on the performance of the films, and others not. But in principle, their position is enhanced. From a distributor perspective, this model really assumes that the distributor wants this film. They're not having their arm twisted. They want to make this film. They think it's commercial. From that perspective, what the fund offers them is greater leverage. For $1 in 3, they can get this film up. They only have to put only have to put a third of the budget up, or cobble together a third this film to go ahead. The debt, as I mentioned, is limited, of course, and by that I mean, the fund doesn't go after them if the film fails. If the film fails, it's okay, we're all grown up. There's no chasing of the distributor to repay the loan. It's not recourse to them. It's not recourse to the producer either. It's just written off. The terms that I outlined are highly preferential terms to the distributor. They get it. It's a good deal. No bank would give them this deal or nothing like it. So it's a good proposition from that perspective. And last but not least, the fund is very commercially driven. And I think, a lot of the time the reluctance and the need for the arm bending of distributors is related to their perception that the films are not commercially driven. This is for them to drive, in a sense. So it is commercially driven. They don't have that complaint. And then lastly, from the government's perspective, from the public policy perspective, there is a precedent for this model, and it does go back to the 70s. It's the Australian Film Commission as it operated pretty much in the late 1970s and the early 1980s, where their decisions to back films were very substantially driven by the commitments of the major distributors, and by that I mean Greater Union and Hexagon and Village and later Hoyts. You know, they were big players in those days. They made very big commitments. The sort of dollars they put into films dwarf even just in nominal dollar terms, dwarf their current commitments. And in real dollar terms, they were very, very substantial investments. So they were engaged with the industry at that time, and we're trying to hark back to that. It's a market-driven intervention, and I think that is, you know, I think the government's general preference in industry measures such as this is for the investment to be substantially, if not fully, market-driven. This is substantially market-driven. As I said before, it's relying on a very big want signal from the market, from a distributor or from a group of distributors. It's not going to be driven by a little weak signal of possible interest from the distributor. It just won't go. It won't drive this fund. Obviously, from the government's perspective, it's a capped commitment. It's $60 million. In the worst case, and Treasury probably look at it just in the worst case, they'll say, we're going to drop $60 million. There might be a happy event where they only drop 31 in our modelling. But from their perspective, whether it's 31 or whether it's 60, it's capped. It's not an open-ended commitment. The cost of delivering it, the administrative cost of running this fund is low. It's not a high-cost fund in terms of admin or delivery. And one more thing possibly to mention, that is that this as a fund is very transparent. It's not mysterious, it's not behind closed doors. Its terms are publicly, they're published, they're available to all, they're witnessed by all. We proposed in the model that any substantial departure from normal terms would have to be published, and furthermore that the performance of the fund would likewise be published. So this is all going to be out there in the open, and that's from the public policy perspective is a good thing. And it's also, I think, a good thing from the perspective of producers to be able to see what is going on and see very clearly what the outcomes are. In fact, one of the things that bedevils our industry is a lack of understanding of information data about performance, and this will give you a good deal of that.